everyone, and happy holidays. My name is Tom Steinley. I'm the Director of Business Development at Lear. We're joined today, as we are each month, by Jim Warner, Head of Research and Co-Portfolio Manager. On behalf of myself and Jim, I'd like to welcome you and thank you for attending the final market and strategy update of 2023. I know Jim's excited to share our outlook for 24 and how it plays into our investment themes and ultimately our security selection. Before I hand it over, I'd like to remind you and encourage you, please ask questions. And the way to do that is through the Q&A box at the bottom of your screen. Jim, welcome, and thanks for your time today.
Great, thanks, Tom. Thank you to everyone who is attending. So let's go ahead and get started. I'm just sharing my screen right now. So what we're going to focus a lot of time on today is our 2024 outlook. First, we're going to just quickly run over what's been going on in the markets, talk a little bit about where we think inflation's heading, and then we'll get into that outlook towards the end. As always, I look forward to your questions. We have an anonymous way that you can use the Q&A button at the bottom of your screen to feel free to lob in anything you want me to discuss. So we're happy to take that time after we finish these comments. So just jumping in, obviously we had 5-6 weeks ago, my phone was ringing off the hook with largely frustrated clients and advisors, wondering where interest rates were going, what was happening. The market had pulled back 10%. And as we've said to folks, time and time again, even in a bull market, we get material pullbacks all the time. In fact, there's a 63% chance in any given year we get a 10% pullback. But that was a lot of stress, and so obviously we had an enormous bounce since then, led by what is essentially lower than expected inflation. So you can see in the chart, core PCE has now come down to 3.5%. And these lower inflation ratings are obviously driving lower interest rates. And so, what a lot of people were concerned about 5-6 weeks ago was the 10-year Treasury in particular had brushed against 5%. Mortgage rates had skyrocketed to 8.25%. These are scary things, and in an environment of high interest rates that we haven't seen in decades. So it was rational to be concerned about where things were going. But, essentially following our own research, we realized that, inflation is coming down and that long-term interest rates needed to fall, and they did. And they've fallen very, very dramatically. In fact, from 5%, and we're now basically in the 4.1% area as the data has the economic data has continued to come out favorable. So we'll get into some of those details here in a minute. Obviously, you can see that from these charts of the S&P, the NASDAQ, and even the equal weight had really nice bounces in November. We focused on the equal weight because that's where, because of the influence that the Magnificent Seven have had over the S&P, most investors are going to have portfolios that more reflect the equal weight. And that's now up 8.2% for the year. So that's great. The other great piece of news is that the aggregate bond index rallied pretty substantially, 4.5% in November on the back of lower interest rates. Now, this is really, I think, a critical piece to the to a thesis that we've been promulgating for the last few months, which is that as inflation comes down, the bond market will actually offer up some pretty exceptional returns. And we were a little early on that call. That can happen. But we've now seen a nice bounce back, and we're very excited about where the bond market's headed in the future. And just to put a little finer point on this, we have been very big proponents of mortgage REITs. And we own 2 of them in our global vigilance portfolio, and we have representation of mortgage REITs throughout a number of our other models that we run. AG&C and Annaly are the 2 that we have, and both had nice big pops during the month. And we think that in addition to the fact that they now offer a mid-teens dividend yield, we love the position that these have in our portfolios. So, a lot of people beat us up on this a month ago and 2 months ago. But we stayed convicted to our inflation research and were rewarded. And we think this is just the beginning, which gives me a moment to pause here to basically step back and, it's really important for you as advisors or you as clients to, understand the difference between what it means to be a speculator and what it means to be an investor. And market pullbacks have a way of revealing your true nature. Now, what a speculator is someone who their behavior is governed by greed and fear. They generally do no fundamental analysis on the positions that they own. They tend to just be chasing sentiment because it's nice and cozy to be where market consensus is. And so they're attracted to these types of ideas. They tend to have a very short-term orientation. Up, we're down, I'm upset, we're up, I'm elated. And they tend to have a lack of discipline. And at the end of the day, speculators are their own worst enemy. Investors, that's what you want to be. Investors act unemotionally. They rest upon extensive fundamental analysis. This enables them to uncover misunderstood value. And applying a long-term orientation and patience requires a lot of discipline, but it is generally always rewarded and creates long-term value creation. And that's what we want for you, and that's what we want for our clients. And that's why at Lear, we believe that we are investors, not speculators, focused on delivering long-term results through our disciplined and fundamental-based approach. And that's very important. And the last few weeks have, I think, underscored why we're different, I think, in that way. So let's take a look at our deflation watch. I've thrown out this nasty D word a few months ago, and we're starting to see this happen. And we've emphasized why it's very important to understand what's happening with housing prices. The general narrative out there is that, oh, don't worry, housing prices will be fine. There's not a lot of sales going on. And we spent some time last month deconstructing that argument and proving that it is false. And we have more data now to share with you. And what you really see in the housing market right now are divergent trends between existing homes and new home sales. So new homes are what just got built by a home builder. What both have in common is that there's record unaffordability. And this has produced a lack of sellers of existing homes, mostly because, as we know, a lot of people are sitting on fixed rate, low mortgages, and they have no real incentive to move. And so there's no incentive to sell. Home builders are different. And you can see, by the way, in the chart on the left, that you've seen this declining. These are annualized, seasonally adjusted rates of existing home sales, and they're just declining. We're about to go into a seasonally weak period, in fact. But these are now about hitting record lows that we haven't seen since the housing crisis. That's how few sales are going on. But on the new home side, it's a bit different. Home builders have been building these houses, and their job is to sell them. And so they're using lower prices, as I'll show you here in a minute, and other incentives to liquidate their new home inventory. And in a normal market, new home sales are about 15 to 20%. We're actually starting to see that mix shift much higher. And as you can see how existing home sales are down, but new home sales are kind of hanging in there. Well, why is that? It's because home builders are cutting price. New home sales prices fell 18% in October. This is worse than we saw even during the housing crisis. You can see in the chart below. This drop actually understates how low new home value prices may go, because many home builders are still providing credits and other sort of mortgage rate buy downs to minimize the monthly payment impact to the buyer. And so we're watching this very closely, but this is basically, new home builders have basically put all their stuff on sale. Now, this could be a problem. And we could see existing home prices follow this trend. Historically, there's a 0.7 correlation between new and existing home prices. You can kind of see the relationship on the graph on the graph on the bottom left here, how they've kind of moved in lockstep. And normally there's a premium paid for a new home versus an existing home. And on average, that's about 24%. But as you can see from the chart on the right, that's now collapsed down to about 4%. So this indicates that if faced with the trade-off of, do I get a new home for roughly the same price as an existing home, I will skew towards the new home. This is going to put downward pressure on existing home prices, and we think that that pressure could be upwards of 15 to 20%. Now, why is this important? Because it all comes back to the core inflation measure that the Fed looks at for setting interest rates, and that's core PCE. Remember some math that we did the last few months, last couple of presentations that we've done. If you get home prices down 15 to 20%, you're going to put up a core PCE number of roughly 0. Now, that's when basically the Fed will go into kind of emergency cutting mode. Now, we're not saying that this is our base case, but we think that this is one of the key things that you need to be watching over the course of 2024. And to make this problem even worse, there's a lot of new homes for sale. There's almost 500,000, which is kind of close to the pre-housing crisis highs that we saw. And in addition, there's 3 times as many homes that are under construction at 1.7 million. You can see it on the graph on the right. That's a record high of new homes that will come to market probably in the next 0 to 12 months. So there's a lot of supply coming, and with prices already down 18%, I don't think there's going to be any relief anytime soon. And if we sort of step back and say, okay, well, let's envision a world where we don't actually have a total collapse in pricing. Even the math, you can see when you look at the Zillow Home Value Index, this is largely existing homes, basically showing no growth in home prices. And whereas you can see, and that's the green line, whereas the blue line is the housing or shelter component of core PCE. And you can see that basically just barely rolled over just a few months ago, basically last spring. And so given that there's about a 21-month lag and we're a few months into it, you're basically going to see in the inflation core PCE number, this downward pressure on shelter prices, on shelter inflation over the course of the next 18 months, irrespective of whether things really fall apart or not. And so all of this leads us to believe that inflation is heading a lot lower than a lot of people think. So, just to put, a wrapper around this and we can move on from this topic, but just an example, I went on to Redfin. I looked at houses between $500,000 and $2.5 million in Dallas. There's about 744 homes for sale, and 208 of them have reduced price in the last 30 days. That's 28% of the listings have already cut their prices. In fact, that's up from only 44 homes in the last 60 days. So there's been a big acceleration in cutting listing prices over the course of the last month. So we're watching this pretty closely, and we don't just look at Dallas, of course. We've been looking all over the country, and this is happening pretty much everywhere. So, more to come on this, but I think that our thesis right now of declining housing prices is pretty square on at this point. So let's get into the 2024 outlook. So at the core of this outlook is that inflation and jobs are heading in the right direction. In other words, the inflation is under control and heading lower, and the labor market is starting to soften from essentially record levels of tightness. And there's a number of different data points, but here I just showed continuing claims are starting to creep up. What this means is that the Fed is done hiking interest rates, and now the market can pivot towards expecting rate cuts. And that's really what drove a lot of the move during the last month. We think that disinflationary forces are very strong, and that, as we keep saying, the market is missing the weakness that we could see in house prices. The one area where we feel less confident is knowing exactly how bad the job market will get. So we're watching this very closely. We've had a couple of announcements already this week from places like Spotify and Bill.com that are laying off 15 to 20% of their workforce, but there hasn't been a deluge yet of layoffs. And so, but as companies put together their 2024 budgets, it may become more prevalent. And so we're watching this closely because that has an important impact on consumer spending, which we'll touch on in a second. But just looking at, and why that matters is because people have jobs. So the JOLTS job openings came out yesterday, and you can see that they're starting to drop pretty quickly. I think the estimate now, based on this number now, there are 1.3 job openings per unemployed person. So that's way down from the 2 that we saw, earlier in the year. But this is a pretty big, and it was also a pretty big miss this past month at 8.7 million versus the estimate of 9.4 million. At any rate, this is just another sign that the labor market is cooling, and it may be cooling rather quickly. And that matters because we need the consumer to keep spending. And it also matters because that they have jobs, because while it's hard to estimate, from all of our studies, there's a Federal Reserve Bank of Boston study, it does not appear that there's a whole lot of excess savings left in consumer bank accounts. So we have to rely much more on the labor market and wages to drive spending from here. So where does the economy sit today? Well, this year, 2023, the economy's strength was really a big surprise to the upside. As you recall, everyone was saying, oh, well, next quarter is the recession, next quarter is the recession, next quarter is the recession, and it never happened. But we think that even in spite of all this strength, it's foolish to extrapolate this strength into 2024, because 2023 benefited from a huge expansion in the fiscal deficit, a big slowdown in inflation, and recovering labor supply. So we don't have a lot of that next year. We have new headwinds, though, to deal with, which is, number one, the impact from higher interest rates. So what is this going to do for people that have, high credit card bills? They have much higher interest rates. What's this going to do for folks that have, for businesses that have term loans that are floating rate? These are going to be bigger drags this coming year than they were last year. We're also finding that banks are starting to tighten their lending standards. And so that could constrain credit. And at a minimum, that could constrain growth, but it also could mean that you could start to see some increased business failures, particularly small business failures. And beyond, and sort of akin to this, we actually have a mountain of debt maturities coming due that starts in 2024 and lasts for a couple of years, and that could increase corporate bankruptcies. So there's going to be some noise in there, where as we see how the various businesses and industries adjust to higher interest rates. But there are also some possible tailwinds. And this is the continued disinflation leading to ultimately lower real interest rates. And ultimately, this could support consumption. In fact, Walmart just talked about deflation in food prices. And that would obviously provide a huge lift to consumers if we saw that come down. So, there's obviously some pushes and pulls here. The artificial intelligence productivity revolution, we don't know where that's going, but that seems to be a net positive. And then there is some stimulus left in the system that's principally from the Inflation Reduction Act, the Infrastructure, and the CHIPS Act. So for 2024, for the U.S. economy, our operating assumption is that the economy will slow, and the question really is by how much. And how much depends on how the economy digests these high interest rates. And so we'll have to wait and see. The labor market is likely to soften, particularly in services, and this could weigh on consumer spending. We think there will be enough economic softness to warrant the Fed cutting interest rates. Right now, the market is sort of expecting 50 to 100 basis points, depending on where you look throughout the year. Who knows? We'll have to see. If our deflation thesis actually comes to roost, there'll be some very significant cuts. But either way, I think we're looking at lower interest rates next year, broadly speaking. We've talked a lot over the course of the last 2 years about rolling recessions, sort of recessions hitting industry by industry, and we think that's going to continue. It's going to hit housing, it's going to hit auto, and any company that needs to depend on financing to grow. So we've seen this particularly in the utilities world, even the last quarter or so, where companies just can't grow as fast because the cost of capital is higher relative to the expected return on investment. And so that's something that we're spending a lot of time evaluating in our companies. There will, of course, be geopolitical events. They will remain present, but we think that for now, at least, the economic impact to the U.S. economy will be quite limited. However, the world is remilitarizing, and could be an impact to the U.S. economy. There is a lot of rebuilding of stockpiles that needs to occur because of the Ukraine involvement. There's also, quite a lot of building going on to prepare for a potential conflict with China, and so that's why we have exposure to defense in most all of our portfolios. I can't talk about 2024 without having at least something to say about the presidential election coming up. And quite honestly, I don't even know who's going to be running in it. But I believe it'll add your typical noise. Generally speaking, you'll see, defense do well when it looks like there's the Republican candidate will win. And healthcare tends to do well when it's a Democratic, presidential, leader in the polls. So there are some of those little trades that happen, but by and large, I think the bigger thing to focus on is that given the ridiculous amount of spending that has occurred both during the Biden and the Trump administrations, there's going to have to be belt tightening in 2025 and beyond. And so there'll be less of a lift from fiscal spending. So put that in the back of your mind that, I think that we're going to start to see more belt tightening going forward. Meanwhile, though, we do have funding for infrastructure, the various different subsidies in the Inflation Reduction Act and the CHIPS Act build out as we try to reshore some key technologies. This stimulus spending should be more free flowing. We really didn't see much of it this year. A lot of the RFPs were out, but starting next year, you'll actually start to see some of that money flow into the economy, which will help support it. As I mentioned before, AI and digitization trends should remain firmly intact. So we like those types of areas. And then I think it'll continue to be another year of normalization from COVID. Industries that have yet to normalize will continue to face headwinds. And so more of the same there. And the crux and the root of the foundation of this, this view on the economy really is that inflation will continue to moderate throughout the year. So this could mean that back half growth is better than front half growth. We'll just have to wait and see. What this portends for the bond market, we think, is very good. We think that the bond market is now in a new bull market. We think that lower interest rates, particularly short term, if the Fed starts cutting, and lower interest rate volatility across the curve is a great market for bonds, particularly long duration bonds. Right now, the market is crowded into cash and money markets, right? Everybody just has piled money in there, earning their 5.25%, 5.5% return, taking zero risk. Not a dumb move. We've had excess cash levels in our portfolios this year for the same reason. But as the Fed starts to cut those short-term rates, you're going to want to move out and take some risk out the curve. So we think that that's going to happen. I'll touch on this next comment in the next slide, but convexity works both ways. That means bonds are sensitive to interest rates, and high levels of convexity means high levels of sensitivity. That's what crushed bonds, during particularly last year, and what will likely really help bonds achieve potentially equity-like returns in the coming year. So we really like the bond market because it finally gives us an opportunity to put money somewhere that will catch a nice yield and not take a lot of risk. We haven't had that situation in 4 or 5 years. So that makes me, irrespective of maybe a gloomier economic outlook, I know that there's a place to hide now, where in the last couple of years there was no place to hide. So, obviously the bond market comes with risks, and one of those risks is credit risk. We are hesitant to take a lot of credit risk in our portfolios, largely because of the uncertain economic horizon. But we're quite happy with high quality bonds, whether it's treasuries or mortgage-backed securities. There's a lot of yield out there to grab, and a lot of appreciation too if interest rates really start to fall. We're avoiding bank debt, floating rate bank debt, largely because we think the Fed's going to start cutting. As I mentioned, there is a maturity cliff coming, so we want to avoid poorly capitalized businesses. So some things to look out for. As I mentioned, convexity, the sensitivity to interest rates that bonds have. back on October 6th, we talked about putting together a long duration investment grade bond basket. These are really, really high quality names that basically had gotten completely blown up. They're trading at 50, 60 cents on the dollar, largely because they had high levels of convexity. And when interest rates rose a lot and rose as swiftly as they did, the price collapsed. This little basket of ours basically is up 14% since we made that call. And you can see that's like an equity-like return. So, there are really interesting opportunities that frankly, we haven't seen in generations. So it's very important, during periods of these big blow-offs that you think with the mindset of what is the opportunity? And you do have to think out of the box a bit. And so that's our approach, at least. So our 2024 outlook on stocks is probably a little more muted than bonds. Lower real interest rates, which is what we expect, are good. They're good for stocks. And so not all stocks are going to perform badly, but the economy is slowing. And there is going to be this impact that I've mentioned from higher interest rates on corporate earnings. So that means favoring strong secular themes like AI, electrification, reshoring. We haven't talked a lot about reshoring in the past, but this whole wave of bringing manufacturing back to the United States, or at least moving it out of China and moving it to Mexico or Vietnam or India, that's a real thing. And those are real big secular trends that you can play, and we are playing. You can continue to follow some stimulus dollars like around infrastructure. And then we favor durable earnings, very durable earnings models. So whether that's consumer staples or defense, we've been certainly, as we've talked about in the past, we've been adding that exposure again to give that defensiveness to the equity side of the portfolio. We highly doubt that the narrowness of the breadth of the market will continue. So this is the whole issue of the Magnificent Seven, as we've gone through, has really driven the vast majority of the S&P's return this year. So if you just own those seven, which of course you can't create a reasonable stock portfolio with just 7 stocks, but if you did really well. The reality is we have this mean reversion opportunity, which I highlighted, which I'll highlight here in a second. So we think that essentially this means start to look for misunderstood value stocks. We can continue to add growthy tech stocks, just not the big, huge, super large guys. And one of the reasons for this is that if you look at that equal weight S&P 500, which strips out the influence largely of the Magnificent Seven, the 2-year gross return on the equal weight is like 0. So in other words, remember when we were back in a bear market? Well, most of the S&P, like other than the 493, other than the 7, have been in a bull market and remain in a bear market. So there's lots of opportunity out there. There's lots of businesses out there that are priced for a recession already. There's lots of businesses out there that are actually they've gone through recession and maybe coming out the other side. So this is not exactly a market where you can paint just one broad brush across it. There's a lot of pockets of opportunity and also pockets that you may want to avoid. So I mentioned this mean reversion opportunity. If you were to buy, if you look at, this is a relative performance graph. So basically, when the line goes up, it means that the rest of the S&P is outperforming the Magnificent Seven. And you can see that basically right almost on the calendar flip last year, the Magnificent Seven, after really underperforming during 2022, flipped the script and basically started really outperforming in 2023. And that has continued all the way down to today, really. And so it appears that essentially those 7 stocks are overbought relative to the rest of the market, and by a fairly substantial amount. So we just think that more thematically, that's actually a great place to look. And if you were to look inside some of our, trades recently, you'd notice that we've been trimming some of our Magnificent Seven holdings in favor of buying outside of that crowd. I can't go on without touching briefly on commodities. So it's a bit of a mixed bag. So we like commodities where there are very lopsided supply-demand dynamics. In other words, there's a supply constraint and a whopping amount of demand out there for that material. And you can see that in gold. You can see that in LNG, and you're going to start to see that in uranium. And we'll talk more about uranium probably next month. But this is, these are examples of where there are applications being adopted, such as take for example, Europe adopting natural gas-fired plants to provide electricity because it's cleaner than the coal they were using. That's driving LNG. China is developing 30 some odd nuclear reactors for clean energy generation. That's going to generate a lot of demand for uranium, and there just aren't that many miners of uranium. So those are great opportunities. Copper, same sort of thing, benefiting hugely from the shift towards all of the applications needed to reach a net zero emissions environment, such as EVs or wind farms or what have you. They all have massively high contents of copper. And so that's a great place to be as well. Gold's a little different. The end of the Fed tightening is going to finally weaken the dollar. We've definitely seen that this past month, and that's helped our gold bet. Gold's hitting new all-time highs as we speak. And it's also a good hedge against deflation if that actually comes to pass. And one of the other ones that I tucked in here that I'll spend a second on is rare earth materials. We've been watching this rare earth market for probably 2 to 3 years. And in our most aggressive portfolio, our tilt portfolio, we actually have a position in a miner and processor of rare earth materials. As we think about the national security interests and sort of the importance of reshoring or onshoring very critical components, whether it's semiconductors or minerals like rare earth minerals that you need in defense applications or elsewhere, this becomes more and more of an important issue to address. And so we like that over the long term. We're less upbeat on oil and natural gas. There is some pretty decent supply discipline, particularly in natural gas, but right now supplies are really high, and so we're generally constructive, but things aren't particularly favorable at this point. What we are avoiding though is agriculture, as U.S. farm income is down, so we think that's going to lead to a bad planting season. There's a question mark right over the economy. I mean, manufacturing, if you look at the ISM report, has basically shows that manufacturing in this country, and actually in many other European countries and Asian countries, has been in a contractionary state, like in recession, for over a year. And so, we're not really sure when that's going to pick up, quite honestly. And some of this has to depend on the direction China goes. But so we're avoiding that for now. And fertilizer are kind of a derivative of the agricultural and natural gas concerns. So the one big caveat before I talk specifically about the portfolio is deflation. Deflation basically is something that investors in this country have not had to really ever deal with. And trying to discount exactly how people will behave is a little difficult. What often investors do when they come to a kind of a fork in the roads where there's a scenario that they have never contemplated before, they try to go back in the history books and see what people have done in the past. What the optical scare, now we have deflation in various parts of the economy already, right? We already see it in consumer goods, and we already see it in energy, and we're seeing it in some parts of food, and the market's handling that just fine. But what happens if that seeps out into, if this housing really comes down, and the headline number is kind of a shocking core PCE number of 0, right? What then? And so, we've listed out, we've talked about this in the past. I'm not going to go through each individual thing that we expect, but by and large, where we think we are from a portfolio positioning standpoint is in a really good place if this were to happen. In fact, we would accentuate certain areas of the portfolio more than we are right now. But this is a tradable event, is basically what I'm saying. It's not something that is, you know, it's not our base case. It's a thing that we think about every night, and that we're preparing for. So let me just quickly touch on the portfolio, and then I'll take your questions. This chart's a little difficult, I'm sure, for you all to see on your screen. And so, when I send out the presentation later, feel free to dig through it. But you can generally see that we're pretty balanced, and this is for our global vigilance moderate risk portfolio. We have, our riskier portfolios and more conservative portfolios and whatnot. But this just gives you a general sense for how we're constructed, which is we've got a chunk of defensive fixed income, which, as I said earlier, if interest rates keep heading lower, this is going to do quite well. And if we have deflation, it'll do really well. We have a chunk of the portfolio in this digital transformation, artificial intelligence sectors. We have a chunk in sort of this natural resources scarcity that we just talked about in commodities. A chunk in mortgage bonds. And then a decent sliver now in Japan and India, which are our two favorite countries and economies outside the U.S. And then some sliver of some value in defensive and healthcare names. So that's just a broad brush of where we are. Obviously the ads that we made and we talked about at the end of October, and we made more in the beginning of November that performed obviously very well. You could pretty much could put a blindfold on and throw a dart at the wall and pick a stock and make money last month. But so those all worked, which is great. And as I mentioned, we also rebalanced the big outperformers like QTech, Microsoft, Google that were in the portfolio. And we were able to do this, broadly speaking. There may be some, account by account, there may be some different issues, but essentially due to all the tax management and loss harvesting we've done throughout the year, we were able to take these gains without creating a serious tax issue for most clients. And that's, I think, also just another thing where we're a little different than I think most people, is that we actually care about taxes because we don't have a client that doesn't hate paying taxes. So it's important for us to do that for people. But let me stop here. I'll just say that I think where we're positioned right now is we are in a good, really solid position to benefit from kind of this slowing economy and disinflation thesis, and we're ready if things were to go, really accelerate to the downside. So let me stop there, Tom, and let's take some questions.
Yeah, terrific. So I'll remind everybody that if you have a question, please submit it through the Q&A box. This is your opportunity to ask questions and hear our opinion on whatever is on your mind. So Jim, yeah, there is a question, first question here. Given your optimism for fixed income, what changes are you considering for global vigilance? And how else do you expect to participate?
Well, so the one of the things, if you've been watching our trades closely over the course of the last month or two, what we've been doing is we too had crowded into some of the shorter end of the curve to collect these 5+% yields. And what you're seeing is a gradual move out the curve. And I think we're moving out probably before most people. We tend to do that. But the market is basically clinging to the front end of the curve right now. And I think that's going to change. And so we are going to continue to move out the curve and take more convexity risk, take more duration. And we want to obviously do that before the rest of the crowd shows up. So I would imagine that'll be the most pronounced difference. I don't see us, like I said, taking any more credit risk. But if we're constantly finding some new and creative ways to invest in fixed income. But right now, we're pretty well loaded up on fixed income. Now, if things take a turn for the worse and we really start to see deflation and we start to see corporate earnings fall apart, we'll obviously get bigger. in fixed income. But for now, I feel really good about where we are.
Great. Jim, if you are concerned, if you're convinced that interest rates are headed south, wouldn't that give a shot in the arm to the housing market, which could increase housing prices?
Well, probably not. And here's why. The average mortgage, rate held by people across the country is 3.7%. And so mortgage rates right now are around 7, and with mortgage lenders having tightened up their lending standards, it's closer to 7.5. That means that basically interest rates need to go a lot lower for for anyone to get anywhere close to the mortgage rates in which the current housing prices were transacted at. Okay. Now, where are current housing prices? They're 50% above where they were in 2019. And if you've been on prior calls, we've done the math. The monthly payment on the same house has gone up, 2-3 times what it was, where most people own their homes. So we have a very, very, very big gap between what I think is, where mortgage rates and prices need to go in order to achieve affordability. I don't have the graph here in this particular one, but I've showed an affordability graph. We're at record unaffordability, like even worse than pre-housing crisis. So we are a long ways away before where I think you're going to see people step up and start buying houses. They're definitely not going to buy houses at current prices, and I also, for that matter, I don't necessarily see mortgage prices or interest rates in general returning to where they were unless we have serious deflation. Could the 10-year treasury trade down to 3.5% next year? Sure, but I don't think we're going back to 2 or 1.5. So I get what you're saying, but I think we are a long ways away from kind of getting to that point where you're going to get that traction again.
Fair enough. Thank you. Another question: is it reasonable to think that with the war ramp up to restock and the forwarding of military contracts to speed up delivery of planes and other large scale hardware, shouldn't that create an enhanced tailwind to the economy?
It would be a tailwind. It's just minute. Defense spending as a percentage of the budget is only 3.6%. So unless we sort of green light some huge amount of money for this, I don't see it really adding more than a tenth here or there to GDP.
Okay, great. There is another question in here regarding our strategic income portfolio. You had alluded to this being the beginning of a potentially long-term bull market for bonds. How is that beneficial to how we manage the strategic income portfolio?
Yeah, I mean, strategic income has had a tough year. It's it's had as tough a year as basically the aggregate bond index, which is only up a few low single digits for the year. Honestly, that could be our best performing strategy next year, depending on what happens, how weak the economy gets, and how low interest rates go. That could be the best performing portfolio. No guarantee, but I think that's kind of where we're at. Is we have the ability right now to get a lot of yield without taking a lot of risk. And there is even the opportunity, as we looked at that that basket of long-term bonds and how they've shot up 14% in just the last month or two. There's that kind of, maybe not that juice, but there's that kind of juice in the strategic income portfolio. So yeah, we're super bullish on it. It's been terrible, honestly, this year, and it was tough to make money last year too because everything was down. But we feel pretty good about it. I mean, the best thing in the world about whether it's strategic income or any sort of heavy bond portfolio next year is that it's finally going to give savers like a real return. These poor savers have had their bonds not work for them for 3 years and they're down. They're flat over the last 5 years. I think the exciting thing for us is that for some of our more conservative clients, we actually can say with a straight face that you're going to get some yield this year. Hope, knock on wood, but that I think we're through the woods in the bond market, and this finally gives us an opportunity. Strategic income is kind of just a juiced up way to play that.
Great. Well, there are no more questions in the queue, and I'll remind people that if they do have questions, please submit them to me or directly to Jim, and we'll get an answer for you as soon as we can. I think we'll wrap it up, Jim. A few reminders. We will send out a replay of the webinar and Jim's slides to each of you on the call. I'll also remind you that the webinar replay, along with Rick's Song of the Week and all the other great content that we published, written by Rick and Jim, are currently available on the LIM app. And if you haven't downloaded the app from the App Store, you'll probably want to do that. It's a great resource. And we'll just wrap up by saying, on behalf of the entire Lear team, we'd like to thank you for entrusting us with your clients' irreplaceable wealth. And we all wish you and your families the happiest of holiday seasons. And we will talk to you again in this format in January. Thanks, everybody.
Thank you.